welcome to this webinar on our reaction to the recent budget and what it means for the property industry. So just to introduce ourselves, I'm Mike Holliday, I'm one of the directors of residential estates. I've been at the company and in the industry for the last 10 years now and seen a whole host of changes over those 10 years in the industry. Alongside myself, we've got Andrew Brassey, who has been in the industry for over 40 years.
Indeed.
So you've seen even more than me.
Yeah, quite a few changes.
Yeah.
Some booms, some crashes, unfortunately. It's interesting times over the past 40 years.
That's it. But together, we not only do we work in the industry and work together, but we're also property investors ourselves, aren't we?
So actually, we know. Do what we say.
Yeah, absolutely. So hopefully, we can give you some good insight into what our reaction was to the budget. We've had a little bit of time now to digest it. We didn't want to come out straight away. I think it's important to properly look into it and what it means for investors.
I think there was a lot of reports coming out, same day, next day, and you think, how accurate are they going to be? It takes time, a couple of weeks to bed in, I think, and for people. Took these insiders we've seen yesterday in London with the farmers, and the complaint about capital gains tax on farmland. It's taken a couple of weeks to get to grips with it, really. And
I think the huge build-up as well, and whether that was because we obviously had the change of government just recently before, I'm not too sure, but I can't remember a budget so highly anticipated than this one for quite some time.
Well, I think there was a lot of uncertainty as to what it would bring, and I think, difficult, but we now have clarity as to what the budget is. But previously it was all hearsay, speculation. As you know, we sit on the Bank of England panel, and there was talk at the last meeting about what the budget would bring, and there were different views coming out.
And some of those rumours, have proven to be true with the budget. Others, it hasn't come through, and then there was a couple of surprises,
unknowns
as well that caught us all off guard.
Absolutely.
But I think for ourselves today, there was two main areas that affects the property industry. One of those was stamp duty, and one of those was capital gains tax. And I think for this purpose of this webinar, we wanted to sort of delve into both of them, what they were, and crucially, what does it mean for the industry, and what do we expect to happen over both the short term and long term, because there is a difference.
I think you're right there, Mike. It's really, what does it mean? We know what the actual is, but what does that imply to ourselves as landlords and potential future landlords?
Absolutely. So, stamp duty. This was probably, it was the biggest shock for our industry that came out of the budget. I didn't see anyone sort of predicting an increase in that.
There was no rhetoric about it at all, was there?
No.
It was not on the agenda, as they say.
But somehow kept that one
very quiet.
Quiet. So just to explain to those of you that are wondering, what the stamp duty is and what it means. So for second home purchases, for buy-to-let investors like ourselves, UK buyers will now pay 5% stamp duty as opposed to the 3% previously on there as well.
Very much so.
It is going to change next year as well for the first-time buyer market.
Yes, it is. I think it was Theresa May created additional thresholds or extended the thresholds so that it became 250, 500. Labour have confirmed that they will not reduce those or extend that time period on the thresholds. So those thresholds will come down. So first-time buyers now will start to look outside of London, pay stamp duty at 125.
Which is really interesting because from a government point of view, it kind of contradicts itself, because they're increasing stamp duty for buy-to-let investors with the hope that the more first-time buyers enter the market and put off some buy-to-let investors. But yet they're going to
penalise
first-time buyers come next year. So it's a little bit of can't make the mind up there. It feels like
very much so. Mixed messages. And I think because of that, we'll see fewer first-time buyers potentially initially coming into the marketplace, which will increase that demand on rental property.
Which makes it more attractive then to have a buy-to-let.
Absolutely.
So what does this mean then? So that's what's going to happen to stamp duty. What does it mean for our industry, the buy-to-let industry in particular? Well, I think in the very short term, and we've already seen it ourselves, you will start to see developers, sellers looking to either reduce prices or offer some sort of cashbacks, something to mitigate against those stamp duty increases and still attract buyers in there. Which opens up a lot of opportunities for clients.
I think we'll see, Mike, in a short period, those incentives that you've just spoken about coming out. But I think as human nature is such that the memory is a short-lived thing, and maybe come the spring of next year, this hike will be forgotten or mitigated, and those deals will go.
Yeah.
So I think if anyone is looking to buy, potentially now's the time to do it.
Yeah,
when
that's
those deals are out there.
Yeah, and you can negotiate a little bit, and it gives buyers a little bit of strength that way.
Absolutely.
So yeah, we don't expect it being a long-term thing that in terms of these types of little incentives. And as I say, so now maybe is the time to have a real good look at it. Other areas of the buy-to-let industry, so the likes of PBSA, purpose-built student accommodation, which we've done a number of webinars of over the years, haven't we? We expect them to become more attractive again, and mainly because stamp duty is not payable on a specific purpose-built student accommodation development, and alongside that, student rents seem to continue to rise as well. So still a really attractive model for
Very
people
much
like
so. We've seen rents rise, certainly with the developments we've been dealing with since COVID, really, or 2021, and they've risen from just some examples from maybe say 150 through to 190 to 200.
Yeah.
So potentially a 33% increase over 3 to 4 years, and that will continue, I think, as we continue with the level of students going to university. I think the demand for accommodation in the right area will still be there. And there's some good buys out there at the moment.
That added to as well, obviously the mortgage rates and stuff like that is still a bit of a contentious issue, and PBSA typically is a cash purchase, so it rules out that side of it. So we could well see a lot of people looking back into that market over the next few months.
And I think, just interrupting there, Mike, I think as interest do drop, and the Bank of England are talking, it'll be slower now because of inflation coming in at 2.3 for October. Interest rates will start to ease, but the student PBSA will still command 8 to 10%. If you buy in the right area and the right property, will still command 8 to 10% net return. So as interest rates ease and your 60, 70k cash will slowly erode, buy into PBSA and it'll stay pace.
Absolutely. The other thing is that we again anticipate is investors potentially looking at more affordable areas of the UK, which has happened actually already this year before the budgets even came out. But just to give you an example and put some figures on this, so someone purchasing a £300,000 property will now pay £17,500 in stamp duty, as opposed to a property worth £150,000 where they would pay £7,500. So that's a 10k difference in stamp duty. Whereas if you look at it from an investment point of view and rents, in a lot of places, if you buy in the right secondary sort of locations, there is not that big a difference.
Not at all. At all. You look at the scheme we've launched in Doncaster, a one bed, 125, 130. That will command 800. You might be very lucky and get 850. And yet, some of the developments we've looked at, or property in Manchester, for instance, at 300, might achieve £1,000, 1150. So you look at the correlation. You're far better off putting that 150 into two properties at 150 as opposed to 300, because you could be talking £1,600, £1,700 worth of rent per month.
100%. So. No, that's it. And the other thing as well is, people, we do get used to tax hikes. 5% stamp duty right now feels quite a lot because we've been used to 3%, but as a country it's still quite low. I mean, you look at the likes of Singapore is at 64%. I think Hong Kong's very high as well.
Very close to that. It goes to, there is no more land in Hong Kong or Singapore. It's very restrictive. So they've got those very high rates. But again, I think you've mentioned that, Mike. But you look at interest rates, and you mentioned earlier I've been in the industry 40 years. I can remember 15% for an interest rate on a mortgage. So when we talk of 5 or 6%, it's still, what it has been, it is still higher than it was in 2009 through to a couple of years ago. But in comparison to what it has been, it's still relatively cheap.
Yeah, absolutely. And it is just a tax, like I say. It doesn't mean it will last forever. No. There will be new governments, there'll be new policies that come forward at some point as well. And unfortunately, you're always going to get hit somewhere along the line. And I think we'll touch on that a little bit later as well when we look to summarise the whole changes. So that was stamp duty. On the other side was capital gains tax. Now this was a surprise for the good reasons, really. I think everyone expected it was going to change. We had a flurry of sellers trying to get out the market quickly, trying to complete before the budget came out. And ironically, it was the opposite in the end. It was those people buying it suddenly were going to pay more because it had dragged on. So capital gains tax remained the same, which was good news overall for this industry. So again, a bit like stamp duty, what does that mean for it? Well, in the immediate term, I think those people I mentioned that were flurrying to quickly maybe sell and do something with it might just calm down. I think we'll see less landlords potentially dramatically looking to sell, which is only going to add to this housing shortage issue, which is so well known, which increases rents and makes it attractive to investors.
There was a report came out, I think it was today, from Savills, saying that over the next 5 years rents will increase by 20%.
Yeah.
So again, talking about, say, our Doncaster scheme, an £800 rent over the next 5 years, if that does increase, you could be looking at close to £1,000 for a one bed in Doncaster.
Yeah.
I mean, good rents.
Absolutely.
And I think probably our own experience is that we have seen rents increase. The property I have in Manchester started at £500 a month.
Yeah.
We're now on £1,200 a month.
Yeah.
It's been a few years. 2007 we bought it, but it's just rents have continued to go up.
Yeah.
There was a stagnating period, sort of COVID time, but after that it just flew.
And that's the beauty of property investing in general. You either get both. You're either going to get a boom in property and prices are going to shoot up, or if those start to slow down, more people are going to rent. So your actually income's going to increase, and it's why us invest in properties. Why so many people do want it. You have to look at it. And we say it so many times. Look at it from a long-term point of view. These little bumps in the road, if you like, should never deter anyone from purchasing it. And in fact, those savvy enough, and we'll get onto it in a bit, may well see it as this is the opportunity when it's perceived to be not a great time to invest.
Absolutely. I think if you look at it, as you were saying that, these peaks and troughs, as we used to talk about, historically, property has always performed, hasn't it? Both on rent and on growth, on capital gain. And it's you should always choose the market in which you sell to make a profit. And probably today is not the ideal time to sell, but it is the ideal time to buy.
Absolutely. And I suppose even if capital gains tax had went up, because the likelihood is we may well have been talking here right now and saying, well, it's gone up, and what does that mean? And I think it's important to stress, capital gains is tax based on a profit.
On a gain.
Yeah, on a gain. So as much as it's not nice and no one wants to have to pay any sort of tax, you've ultimately made a profit, and you're getting slightly less profit than what you were, but you've not lost any money or anything like that, and you're in a good position for you to suddenly have to pay those tax a bit. So again, it shouldn't never really deter anyone from purchasing a property.
No, I think if you buy into the property market with a negativity of thinking I'm going to pay capital gains tax at some point, I think I would question why you buy it. You should be looking to say, how much tax am I going to pay? If I'm paying 10, 15, 20,000, happy days, because I have made 100,000 maybe, something in that order.
And I think it depends as well on your model when you purchase property. We see a lot of people these days who purchase property and they look to remortgage further down the line, they pull money out of it, and crucially there is no capital gains tax when you remortgage a property and you pull money out that way, so it wouldn't have affected those types of investors as well. So it could well have happened, it could have increased, it still wouldn't have been the end of the world for this industry, but it's nice it didn't happen.
Very much so. So those people who are selling, it's a bonus to them. Those people who are looking to buy, if it stays equal, it won't impact on them when they do sell in 5, 10, 15 years.
That's it. So overall impact of the budget, they're the two sort of breakdowns of it. I mean, as we mentioned it at the start, the change in government, I think, in general, has panicked quite a few property investors.
As it always does.
It does, yeah. And in particular this way, I think the general consensus is a Labour government sometimes doesn't benefit the property industry. However, history does actually go against that slightly. We've been looking at some stats on it. So in Labour power, they have actually seen 119% property growth during their terms in power, as opposed to the Conservatives, where it's only been a 5% increase in property prices. So that's from the point they take over power till when they leave.
Which is probably quite a surprising statistic, isn't it? Because I would have thought under Conservatives, the capital appreciation would have been higher.
Yeah.
Certainly higher than 5% anyway.
Well, and we sort of looking into it, weren't we? Of how has that come about? What's the reasons for that? And I think one of those theories is that people do naturally believe, when Labour come into power, there is that negative thought of, I'm not sure I'd buy a property right now.
Yeah.
They hear stories in the press, it's not going to be great for those, people at the top, so to speak, with it. So what that means is people don't pile into the market at that point. However, towards the end of the term, more and more are realising property is the right thing to put money into, and stocks and shares and things like that maybe aren't quite giving them the returns they want, which leaves way to this growth in property price, which you maybe don't see in the Conservatives' power because they continue to buy with it. So what does that tell you? Well, it probably tells you now is a good time to get in there, and maybe we will see a change of government in 4 years or whenever we think, and you'll see that growth as history has suggested with it. And we've often said on webinars, haven't we? If you're hearing it on the news that it's a good time to buy property, you're probably a little bit late to the market.
Yes, you've missed the boat. Maybe.
So that's it. And we mentioned it. People do get used to tax hikes. The likes of the stamp duty, the 5%, we're all a bit shocked at the moment, but it will become the normal for now.
Absolutely.
It'll be, once it settles down, prices will start to rise, and it'll be interest rates that takes over the news as well. So it's take advantage of the right now of it. It's always a good time to buy property if you're in it for the long run, which you always should be.
I think you've mentioned that there, Mike. I think maybe the short term, as in buy it today, sell it tomorrow, market has gone, and it needs to be medium to long term investment. Because we are seeing some people who bought last year, this year, looking to sell, and in fairness, there hasn't been a great uplift in price. Talk to someone who bought maybe 3 years ago, and yes, they have seen that uplift. 5 years ago, it's even better still. So I think you're right. It's medium to long term.
And we mentioned it before. Nothing does last forever with that. The recent example was COVID times, wasn't it?
Absolutely, yes.
At the time, I think everyone thought at that point, what's going to happen? We were all uncertain with it. But actually, what a time if you could go back in time to buy just before then, and prices did sort of boom.
Yes. Straight
after it. It had that similar sort of feel before it of uncertainty that it's in now with it as well. And finally, we touched on it. What are the other alternatives to putting your money into other than property? Stock shares fluctuate; they go up and down. Gold, whiskey investments, all those types of things.
Yes.
There is not enough history really to back them up over a long period of time to show no risk.
Certainly those alternatives, as you just mentioned, whiskey, it's quite a quite a new investment strategy, and there are some good stories out there. Macallum has performed very well if you have a certain bottle of it, but if you don't, it's just a bottle of whiskey that sits on the shelf. Not every brand is going to make a good return.
That's it, and there's nothing better than bricks and mortar. You can touch, feel it. We're still that small little island, really, with not enough land, and that's and a growing population, and that's never going to change with it. So
it's not.
But, brilliant. Well, thanks very much, Andrew, for running through that.
More than welcome.
With me. Hopefully you found that interesting. Like I say, we'll back it up with some stats, and if you do ever want to talk to any one of our experienced team, please do get in touch and we can go through it into much more
in greater detail.
But an interesting budget, but certainly shouldn't put anyone off.
No, I don't think
investing
it should.
in property.
I don't think it should.
Yeah.
Doesn't put me off anyway.
No, me neither. Brilliant, thank you.
Good night.